Hello and welcome back to the channel. My name is Zach Collins and this Financial Education. Today I'll be talking about debt. Now in this economy we're seeing massive high inflation. Jobs are being cut or wages are just being kept flat. This has caused a lot of people to experience a cost of living crisis and taking out debt to help fund their lifestyle. Well, I can't really help with that. Hopefully I can give you two different strategies that people use to pay down their debt and maximize their wealth and well-being. These two strategies are known as the snowball and the avalanche methods. The snowball method, as the name suggests, is where you start with something small and over time you work your way to get bigger and bigger. Before I continue, I do just want to emphasize that with both of these strategies, they both have the same minimum requirement. That is, you must continue to pay these debts. Do not let them go into default. Make sure you continue to pay the minimum on all the debts you have. It's just about how you pay off these debts and which ones you prioritize that differentiates them. Okay, getting back into it. So with the snowball, you start with the smallest debt value you have. Let's say you get a $2,000 credit card and a $20,000 car loan, and then a $200,000 mortgage. You start off by paying down the credit card first because it has the smallest balance remaining. You then focus on the car loan, finally the mortgage. The principle, the snowball and avalanche methods, is that you make sure you continue to pay the same amount even once all the debt is gone. You just focus on a different debt. Rather than just using arbitrary numbers, let's use a bit more of an understandable example. Using the same credit numbers I mentioned before. Let's say you have $2,000 per month that you can use to pay down these debts. Let's assume that the minimum payment on the credit card is $100. The car loan is $500 and the mortgage is $1,000. This means that just paying the minimum amount on all these loans is $1,600, leaving you $400 per month to choose which debt you focus on. If you use the spare $400 on the credit card, it will then take you 5 months of $400 per month to pay off your $2,000 debt. From month 6 onwards, you will then have an extra $500 per month to pay down the car loan, as you have your initial spare $400 plus the $100 you were spending on that credit card. This means with your extra $500, it will take you 40 months to pay off that the $20,000 car loan. 40 months equates to about 3 years and 4 months. This means the first 2 debt payments will be fully wiped in less than 4 years, just leaving you with that big mortgage left. You would then have an extra $1,000 per month to focus on the mortgage, and it would more than half the amount of time left on that loan as you're paying double the minimum required payment. The gain by using the snowball debt strategy is that mentally you know you have less and less debt. You start off with 3 distinct loans. You've now paid off 2 of them and you've only got 1 left. The next strategy that I go into, avalanche, it does not necessarily give you the exact same peace of mind. Now, before I move on, what I really need to emphasize here is that the numbers I'm using, they're arbitrary. And they basically all assume that you're paying interest only. If you were paying principal as well, you would already be paying down the loan each payment you're making, and these extra payments are just speeding up the process. The 4 years I said it would take to pay off the credit card and the car loan would actually be closer to 2 or 3 if you're already paying P&I. The avalanche method is where instead of focusing on a dollar value, you focus instead on the interest rate of that debt. So using the 3 different types of loans that I mentioned before, credit cards tend to have the highest interest rate because they are unsecured debt. A car loan would be next as it's secured. The asset does depreciate and it's a non-essential good. Finally, a home loan tends to have the lowest interest rate because it's secured against an asset that tends to appreciate in value, meaning it is less risky for the lender and everyone needs somewhere to live. If we were to do an example using the same dollar amounts as we did before, we would actually use the exact same order of operations. Credit card debt, then car loan, then home loan. Because as I said before, that tends to be the order of the highest interest rate. If we changed up the dollar amount, and now the car loan is $2,000 and the credit card is $20,000 of debt, we would be focusing on the credit card first, even though the car loan has a smaller dollar balance. The reason it's called avalanche is because you are paying the highest interest first. You knock out the highest amount and it then cascades down to the lower interest rates once it's fully paid off. From a mathematically point of view, paying off a high interest rate is going to result in a higher benefit than just paying off the lower balance. And this can be explained using some maths. Let's say we have a $2,000 debt at 15% interest, $2,000 at 10%, and $2,000 at 5%. So it's costing me $300 per year to have debt 1, $200 for debt 2, $100 for debt 3. If you have $2,000 to spare in a savings account and start to pay off one debt. If you choose to pay off debt 3 first, great, you save $100 per annum in interest, which is honestly, it's great. But you're still paying $500 each year for the other two. If you instead chose debt 1, you'd be saving $300, and it means the other two, you're only paying $300 in expenses. This means you're benefiting the difference, which is $200 per year. Now, this $200 bonus savings means you can then roll it into the other ones, paying the amount faster and compounding the rate of debt pay down. In economics, there's this idea called opportunity cost. If I did X, what is the cost of not doing Y? Using the debt pay down, whether you choose option 1 or 2, you still have some benefit. You get a guaranteed benefit of 5% or a guaranteed benefit of 15%. Honestly, both are great outcomes. However, the opportunity cost is the difference in the return between the two. If you chose the 5%, your opportunity cost is 10%. So that's the difference between 5 and 15%. Every dollar you spend is costing you 10 cents, doing X over Y. If instead you chose the 15% debt, the difference is minus 10%. That means you're making an extra 10 cents for every dollar using that strategy. Everything I've said today, it just looks at the straight debt balance and the debt interest rates. What you need to be mindful with your specific scenario is that some loan types have fees and costs paying them out early. So you need to be mindful of that and whether it's actually beneficial to do this. Many types of debt also have monthly or annual fees or fees per payment. This again needs to be factored into your calculations around which one you need to focus on. Just because the interest rate is the highest or the balance of the debt is the lowest does not mean that using either of those two methods, any specific debt is the one you need to be focusing on first. Paying down debt is a great way to turn your life around and to start building wealth. Just make sure you sit down first. Look at every debt you have, what the fees are, and what actually costs you each month, and whether it makes sense to pay it out or not. Only you and the specific loan contract can determine that. Hopefully, I've been able to give you guys a better understanding of the different types of debt repayment strategies that you can target and use and mentally get yourself stronger. Today, I'll be going through a few different budgeting strategies that people use to make sure they keep on top of their income and expenses. We're currently living through a high inflation and wages are really not keeping up. So this means it's very important to keep on top of your budget and make sure there's no shortfalls that then end up being covered with high interest debt, spiraling you more and more into debt over time. There are 4 very common debt strategies that people use, and I'll be going into them today. So they are the zero budget, pay yourself first, 20, 30, 50, and the envelope budget. So the zero budget and pay yourself first budget strategy are both very similar, but they approach the issue of savings from opposite sides. With the zero budget, basically you zero out your different allocations each pay cycle. For example, if you allocate $100 a week to food and you spent $90, that means you've got $10 left over. If you allocate $50 to your phone internet bills and you spend $49, there's $1 left over. What happens with the savings? That's where the surplus goes. It's not a predetermined number, and so the amount you save each pay cycle would change based on how much you actually spent. Unless you're really good at following your budget for each spending category, the possibility of exceeding your budget any period is actually quite high. So you might underspend by, say, $5 in one category, but overspend by $50 in another, meaning net you're down by about $45. The type of person that would be drawn to something like this is someone that would want to be more disciplined with their savings and their spendings, but they also don't want to be too formal and limit their expenditure when something unexpected does come up they might want to spend their money on, such as tickets to a concert or travel. The pay yourself first approach, as I mentioned, is similar to the zero budget. The difference here is that you allocate to your savings first. You decide how much you want to save each pay cycle. This can be as low as a few dollars or can be as high as the majority of your income. The difference is that the second you receive your pay, you put that amount straight into savings and you never touch it again. With the amount you have left, then you stick to your regular budget. If there's any money left over, you can spend it however you want, as you already have that dedicated savings buffer. If there's not enough and it's still a few days away from your next pay, that's when you really have to look harder at what you're spending your money on, where and how to cut your expenses to make it to payday. I'll now move on to the envelope budget. So with the envelope budget strategy, there are 2 ways you can do it. One is with a number of bank accounts, and each with their own transaction account, debit card. It's a bit convoluted. Or you can use it with the namesake, a bunch of envelopes and cash. So I saw this budget go viral on TikTok a little while ago, and people talk about how brilliant it is. Look, honestly, it's been around for a long time. It's really not new. Possibly the concept of using cash for everyday expenses instead of mindlessly just tapping your card could have been what blew people's minds. Anyway, the envelope strategy is fairly straightforward. At the start of your pay cycle, you take out however much you need. You put that into an envelope titled for whatever type of expenses you're budgeting for. If you only want to spend $50 going out to eat, get the envelope, chuck in the 50. If you want 300 in groceries, $300 into that dedicated envelope. Similar to the pay yourself first budget, once your envelope is out of cash, it's out. There will be no more money allocated to that expense until the next payday. Before I move on to the final budget strategy, I do want to say once you have run through your budget, it's really not the end of the world. Hopefully you've set aside some savings from your pay and can dig into that if an emergency does come up. Also, skipping meals to save money is really not healthy and probably be a detriment to your working career and earning an income. So it's best to make sure you don't stop eating for a week if you've run out of your allocated funds. If you do run out of money, then it's a good time to look at what you're actually buying. Are you buying takeout for lunch and dinner every day? Are you buying too many video games? Are you gambling, drinking, smoking? Whatever it is, ask yourself, does this expense need to be incurred? If you need to reduce your consumption or cut out completely in order to stay within your budget, that's where you need to make the sacrifice and decide, is this expense worth it for me? If yes, time to increase your budget. And you can either cut down on your savings, which will negatively impact future you, or you can see if you can reallocate from some other spending category. The final budget strategy is called the 50-30-20 budget. And this is a very common one that's talked about online with a lot of financial YouTubers and influencers. So why is it called 50-30-20? It's because 50% of your income goes towards your needs. This is stuff like rent or mortgage, groceries, petrol for your car, utilities, etc., etc. 30% goes towards your wants. Now, included in this 30% can actually be stuff that's already in your needs category, but maybe it's something you want to upgrade and get something a bit more luxury. You could buy a cheap car. That would be a need if you have to travel for work or you can't get public transport. Getting a more expensive one, however, would be a want. So I personally would allocate the difference between what the two cars would cost into your wants basket. Other expenses that would come out of this 30% budget would be the stuff like going out for dinner or gym membership or travel. The final 20% is for savings. So saving can be short-term or long-term, and this can be kept in plain old cash in the bank. Nothing wrong with that. It could also be investments in managed funds, ETFs, or could be longer-term investments like super. Make sure to check out my other videos on the channel on these topics where I give a brief overview of how each of them work. In Australia, we're actually very lucky and that we get super guarantee. This is paid on top of our gross salaries. It's currently about 11% and it's a forced savings. I personally try to save on top of my SG, but I know that a lot of people in a lot of debt that would argue that it's better to cut your savings allocation and increase the other two. When it comes to budgets, there is no one size fits all. Everyone has a different spending habit, and the psychological nature of picking one over the other can vary so much between different people. And that can be the difference between keeping to a budget or not. And that's why it's important to try out all of them so that you can make which one works for you and which one doesn't. Hopefully I've been able to give you guys a better understanding and the premises behind how to budget and the different types of budgets out there, allowing you to pick one that works best for you. Today we're going to be looking at some magic. Now, I'm no Andre Jick, so I can't do actual magic, but what I can show you is the magic of compound interest. As Albert Einstein once said, compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. So let's start off with what is compound interest. So compound interest can go one of two ways. It can either make you money or it can cost you money. So inflation is a very good example of where compounding negatively affects us. So what does compounding actually mean? Let's give you an example. So let's say you have $100. If you get an annual compounded return of, let's say, 10%, this means in year one, you get $10. So now you've got $110. Let's say in year two, you get the exact same 10%. On that $110, you're now getting $11. This means your portfolio is now $121. You again get 10% compounded the next year, and this means you get a return of $12.10. Meaning your overall portfolio at the end of year three is $133.10. If you compare that to a simple return of the same 10% a year, it means you get a return of $10 each year. This would mean at the end of year three, you have $130. compared to $133.10 with the compounding return. Now, this $3.10 might not sound like a lot of money, but if you're comparing it with hundreds of thousands of dollars invested in a market or over a much longer period of time, decades for example, the difference between a compounded return and a simple return makes a massive difference. And I'll show you a few examples of compounding now. So let's start with the magic trick of how to devalue a currency. So as I've said before, compounding works in multiple ways. It can make your portfolio grow faster or can make your money worth less. If you haven't watched the previous video where I detailed what CPI is, after you finish up this one, make sure you go through my channel and have a good watch. And I'll give you a bit more of a context to what I'm talking about. So let's start off with currency devaluation or inflation. So let's go into the Money Smart compound interest website. I'll make sure to link this below. Here we are on the Money Smart compound interest calculator. Let's show you what happens when you devalue a currency. Now, what I'm going to do is I'm going to insert the initial value of $100. So let's say it costs you $100 to buy a pair of shoes today. The RBA tries to keep the inflation rate at around about 2 to 3%. So what we're going to do is we're going to put this into here. It does go up. We do see quite recently actually close to 9%, and at the moment it's about 4 to 5%. So it's a lot higher than the 2% target. But just for simplicity, I'm going to use 2% today. This will look a bit different because this is actually for growth, but you can consider it the exact same for inflation. So let's see what happens in 10 years' time. What we've got here is we've got $122. This would mean that in 10 years' time, the value, assuming the shoes are exactly the same and they have not changed, like they're still selling for equivalent of $100, they're now selling for $122. If we were to then change this out to 20 years, we can see it's now jumped up to $149. So there was a $22 difference in the first 10 years, but now there's a $27 difference in the second lot of 10 years. So that means you've lost another $5, which is about a 25% increase in the devaluation of currency. So it's now costing you $149 to buy the exact same shoes that would cost us $100 today. So let's go to a little bit of an extreme now. Let's say, how much do these $100 shoes cost us in 50 years' time? You can see here, it's now actually costing us $272. Considering we start off at $100, that's now over 2.5 times more expensive for the exact same thing. And it's a really good way to see that this is just using a 2% inflation. As I said before, it's currently in the 4 to 5% range. And quite recently, it's been as high as 9. It really goes to show just how much inflation rate can affect the value of goods over time and how important it is to make sure that you are increasing your wealth and income each year, whether that is through investments and getting income and capital returns through that, or through getting a better job or getting a pay rise in your current job to make sure that you are keeping up at minimum with inflation. What costs $1 or $2 today is going to be significantly more expensive in the coming years. Okay, so I managed to show you guys how deflation works. Go from $100 pair of shoes to $200+ pair of shoes for the exact same thing with just change in time. Now let's do something a bit more fun. Look at what happens if your portfolio grows over time. Now, I can't actually use this compound interest calculator because it only goes up to 50 years. So I've actually got one that I've made myself, and I'll show it now. Okay, so here we are on the Excel sheet. What I've got nothing here, but it will pre-populate once we put in some numbers. So let's start and have some fun. Let's assume I've put in here the inflation rate. That's 2%. Personally, I like to make it a bit of a higher inflation rate. I like to go about 3%. As I said, the RBA target is 2 to 3%, and 3% is at the higher end, and that just gives us a bit more of a buffer. Up until pre-COVID, it has been a lot lower. It's been around 1, and this 3% just gives us a better buffer, and this will give us a return in today's dollars. For a return rate, 7% is fairly conservative. You could consider going up to 8 or 9, but I like to stay at 7% nominal, with 3% inflation giving us a 4% real return. So real return is what the value of your portfolio growth less inflation. So what we'll do now is see how long it takes to build a portfolio of $1 million. Now, let's say you start off with $100. Now, if you did nothing, you can see you're getting 4% return each year. It's grown over time. And if you did nothing, it would take you 235 years with 8% real return to get to $1 million in today's dollars, that is. Now, let's say we were to contribute $100 each year. Now, you would need to, because this is all in real dollars, you would actually need to increase your contribution with inflation, which is fairly easy. But you can see we had over 230 years before. Now, if we were to do that today, it brings us down to 153 years. I mean, that's still quite a long time, but you can see that this growth rate is actually increasing every single year. It is 4% in the first year because it's 4% of $100. It is then 4% of $204, which is $8.16. You can see by the 18th year, it is actually more than what we're actually putting in itself. It doesn't take long for it to be significant money. We're here 60 years to get to over $1,000, which is 10 times what you're putting in each year. 120 years to get to 10 grand. And then if you continue on further, 177 years to get over $100,000 a year in returns. So you can see the magic of compound interest is just how rapid it accelerates. To go from $12 to $100, which is a 10x, so it takes 15 years to increase your growth rate by about $90. To go up another $90 to come here is 9 years. It's almost half. And then to go up another $90 from 28 to 36, it's seen as 8 years. So it is going up faster and faster. And that is the magic of compound interest. I'll do one more very quick example. And this one's just more for fun. Now, how long do you think it would take to become a millionaire when you start with 10 cents and you contribute 10 cents a year? First thing to see is it takes 18 years for us to start having the growth being the same and greater than what we're putting in. It takes us almost 100 years to get to a portfolio balance of $100. It then gets us 150 years to get to $1,000, 212 years to get to 10,000, 270 to get to 100,000, and 329 years to get to $1 million. I don't think any of us are going to live to 330 years old, but it really goes to show you started off with 10 cents and you're only putting in 10 cents. While it did take a really long time to get to $1 million, it can happen, and all it is being consistent. This calculation is, look, it's not going to be representative of what the world actually is, because the market goes up, the market goes down, market goes flat. Each day is different. Each week is different. Each month, year, each decade is going to have a different return. This is just a very simple compounding using long-term averages. It is not representative of what the actual market does. Look, hopefully I've been able to give you guys a bit of a better understanding of how compound interest actually works and why it is so very important to get started early. If you've got any more questions, make sure to drop a comment down below. I will answer if I can. Thank you so much for watching, and I'll see you guys in the next one.